Hello everyone, thanks for checking out my video. The US market continued to hold up with relative strength even when the trading volume dried up a bit on the verge of a long holiday weekend. Recent economic reports have shown that the US economy and labor market are slowing down. With this, the market sentiment is a little mixed right now. On one end, you have investors cheering for signs of economic cooling, hoping that the Federal Reserve can pause their interest rate hike campaign soon, while on the other hand, the talk about US entering a recession starts all over again. Without further ado, let's dive straight into the details. All three major US stock indices were a little weak at the start of last week, but bounced back on Thursday before the long weekend, with several mega cap momentum stocks leading the way. The late reversal on Thursday was likely due to the latest weekly jobless claims number, which came in higher than expected. Basically, the jobless claims rose to 228,000, well above the expectation of 203,000. And to our surprise, the previous week's jobless claims number got revised sharply from 198,000 to 246,000. To be honest, I am a little puzzled as to why they can just revise the number like that. Nevertheless, these data suggested that the labor market is cooling and it is feeling the effects of the Federal Reserve's aggressive interest rate hikes designed to cool the economy and curb inflation. To add on, last Friday, when the market was closed due to Good Friday, non-farm payrolls number was released. It came in at 233,000, just under the expectation of 240,000, and less than February's 326,000. This further suggested that the job growth rate is cooling. However, the unemployment rate slipped to 3.5% from the previous month of 3.6%, which actually indicates a tighter labor market. To me, this is a mixed result and it can confuse the market. More on this later as I share my end thoughts. Anyway, what I think and what we think isn't important. What's more important is how the stock market thinks and reacts. The market had the weekend to digest this data before Monday's opening bell. Anyway, going back to the jobless claims, typically the number of people filing for jobless benefits hovers around 200,000 per week in a healthy labor market and 400,000 or more during a recession. Therefore, in terms of market outlook, keep an eye on these numbers in the upcoming weeks as the recent layoffs by many mega cap companies are starting to impact the overall employment situation. With the labor market slowing down, as the Federal Reserve and many of us had anticipated, there will be more speculation that Fed will pause their rate hikes campaign sooner than expected, with the market now pricing in about 50% chance of a pause at the upcoming FOMC meeting in May. But before that meeting, two key events to highlight. The first one, which is the most critical event of this week, would be the release of CPI data on 12 April, Wednesday. This by itself could shake things up and change the current trend. The other key event is that this week marks the start of another quarterly earnings season again. Hundreds of banks will report their earnings and guidance in the next 2 weeks, starting with JP Morgan Chase, Citigroup, and Wells Fargo as they get things underway on 14th of April. Personally, I think it will be interesting to see how the recent banking crisis has affected their earnings and forecasts, and also how much deposits have been shifted from the smaller banks to the bigger banks. Okay, let's now have a look at the technical charts. For SPY, it is looking bullish now with a bullish engulfing candle appearing last Friday. Bulls will want to push SPY above that green dotted trend line, which is around 414 to 416. If SPY can break above the recent high of 416.7, then it's very bullish and I wouldn't go short, because the next target will be that little gap at the top between 419 to 420. Further momentum could bring it to August 2022's high of around 426. That will form a level of resistance. If that breaks, wow, that is when I wouldn't want to be on the bearish mode, as the next target will be 430's range. In fact, I will be quite convinced that a new bull run is underway if we reach that range. On the other hand, let's say the market reacts negatively to the latest non-farm payrolls report and wants to go down, the first resistance will be the recent high of around 417. If bears and sellers step in at this range to push the price down, we will then have a bearish double top pattern. When that happens, three gaps at the bottom will act as a magnet to pull SPY down. The first one is around 404, the second one is around 401, or the last one at 396 to 398. To be honest, even if we touch these three levels, bears will still not be in control yet. They will only be in control when SPY breaks below the 61.8 Fibonacci level and the 200 moving average, which is around 389. Therefore, to sum things up for SPY, I will not be a bear unless the three gaps get filled and SPY starts to test and break below 389. As a gentle reminder, I have emphasized a few times already that the market is very resilient now. With so many doom and gloom news going on, it is still holding up quite well. So, if you are a permanent bearish trader, good luck to you. The potential landmine and chance for you will be the upcoming CPI number and super poor performance from the earnings season. Let's now move on to Apple. When I zoom out the chart, it seems like whenever we have this kind of steep and parabolic run-up, we will have a significant pullback. It happened about 3 times since October 2021. Furthermore, Apple is about to hit this long-term downtrend line resistance, and I think we can expect some sellers to step in just before or around that area. On the downside, there are 2 gaps waiting to be filled, one at 161, the other one at around 158 to 159. Support is at around 157. Again, just like SPY, BEST has a lot of work to do to gain back control. They need to break below the following 3 levels before I am convinced that the bears are back. These levels are 50 moving average at 153, 38.2 Fibonacci level at 150, and the 200 moving average at 149. If we were to break the 200 moving average, then the probability of us filling that gap at 146 to 147 would be high. On the upside, if Apple can break above the red dotted downtrend line, then I would say the bullish momentum is very strong and we could easily fill that gap at 170. And yes, when was the last time we saw 170 with Apple? It's a good 6 to 7 months ago. And if we can break above August 2022's high of 175.6, I think there is almost little to no reason for us to remain bearish anymore. Just like SPY, I will then be convinced that we are off to a bull run. Unless, of course, shit hits the fan again. Okay, now let's talk about Tesla. Tesla is looking interesting to me. So last Friday, when lots of tech stocks like Apple, Meta, Microsoft, Amazon were rallying, Tesla was pretty flat as it closed the day at 0.25% lower. Anyway, I shared on Moomoo platform that there were 4 bearish signs spotted on Tesla chart, so I am going to share them now here. Firstly, Tesla had a bearish MACD cross. Secondly, it has fallen into the Ichimoku cloud. Not sure if you recall, I sold a put option 2 weeks ago because Tesla was able to float above this Ichimoku cloud. And now it has gone into that cloud, and that's bearish. And in case viewers wonder why I flip-flop my position, I just wanted to share that I trade and adjust my stand according to price action. So am I worried about that option? Nah, time decay has already set in, and that trade is in the green now. Okay, sorry, I digress. Where were we? The third and the fourth bearish signs for Tesla would be that it has broken below the 50 moving average and the 23.6 Fibonacci retracement level. Anyway, I understand that this bearish message is actually an unpopular opinion, especially when the broader market SPY is rallying and Apple and Microsoft, being the biggest 2 US companies, are going strong. And yet I am painting this bearish stand for Tesla. Well, this just means that I try to be unbiased and present what I see on the chart to everyone who watches my video. I mean, I could be wrong and Tesla could fly. But here's the interesting part. As those bearish signs pan out, Tesla suddenly announced it is going to reduce their pricing again. Someone must have known something. To add on, Elon Musk's brother has sold 100,000 shares of Tesla stock worth almost $20 million on 3rd of April. I guess that explains the weakness and sell-off last week. And who knows, come this week, all the chatters on Tesla's demand concerns, reduced profit margin will start to surface again. So if the weakness continues, watch out for 171 to 173. This area would be a strong support. If this critical level breaks, wow, we are talking about 150's range again. Anyway, I am a long-term Tesla bull. I'm just sharing the bearish signs that I saw right now. So please don't shoot the messenger, and of course, I stand corrected. Okay, a very quick one on this again. So last week I had this support challenge with the following tasks. First, it is to receive 2 coffee support from the fellow viewers, and you guys did it. So I would like to take this chance to thank Russell for the support, as well as another gentleman whose name starts with the letter D. Sorry that I didn't share your name here because as shared in my previous video, if you do not drop a comment below, I will take it as you would like to remain anonymous and do not want to be mentioned in my video. Once again, thanks both for the support. Next, I have also received more than 30 likes for the last video. Thank you all for tapping the like button. So for this week, again, I hope you can lend your support by completing one of the following tasks. Let's aim to hit just one task and I will be very grateful already. First task, 1 coffee supported for this week. If you have supported through this task, please comment below and I will thank you in my next video. Second task, the most likes that I have ever gotten for my videos is 45 likes. Can we break this record? Third task, if you haven't signed up for Weibo and need another brokerage app on top of Tiger and Momo, please use my referral link below. We both will get free shares in return. Just like the first task, if you have supported through this task, please comment below and I will thank you in my next video. Okay, back to business. On the other hand, if the bearish signs get invalidated on Tesla's chart and I am wrong, the first upside target for Tesla bulls is around 190. If Tesla can close above it for about 2 days, then the pendulum will swing slightly to the bull side. It will be even more bullish if we can start charging towards 216 to 217, where the 200 moving average and the recent high point are. That is where a heavier resistance will come into play. That said, if Tesla were to hit this level, it also means that it will move out of the Ichimoku cloud, which is a bullish sign. Moving over to Google. Google is looking bullish right now, as it is riding the AI wave with Microsoft and Nvidia. At one point, this AI bubble will come to a halt, just that nobody knows when. Anyway, Google broke above the recent high of 108.18, that's bullish. MACD was on the verge of curling down but make a U-turn, that's also bullish. Then last Friday, Google printed a solid candle into this top half of consolidation zone, that's bullish too. And if this bullish momentum continues, we could easily fill that gap at 109.1 to 109.9. If Google continues to stay around this consolidation zone, I will not be surprised if it slowly grind up towards 118 to 120 range, and that is the top end of this particular consolidation zone. On the other end, if the bubble decides to burst this week, could be due to CPI or anything, we could then form a bearish double top pattern and fall back down. First support is at 105, followed by the psychological level of 100. A bigger support is at around 98, where the 61.8 Fibonacci level and 50 moving average sits. If this level is breached, I think the chance of falling to low 90s is quite possible. Okay, for this week, I don't have much update on my option trades, but I thought to use this opportunity to highlight one particular trade, and that is this covered call on Google. I wanted to show this because I didn't want to paint only the rosy stuff or trades that are sitting on nice profit. For new option traders, this is one good example for reference. So, this trade is down about 63%. Am I worried? Not really. Firstly, I have seen trades that were down 100% or 200% and ended up swinging to my favor. Therefore, 63% is still alright. The message here to newer option traders is, please expect such volatility and downside in your trade. You have to get used to this, and most importantly, have a plan in mind. Okay, so here's my plan. This trade has about 2 more weeks to expiry. If it continues to go deeper in the money this week, one action that I can take is to roll this option by extending the expiration date. Strike price wise, I can stick to the same strike price or increase it to say 108 or 110, depending on how much premiums I want to collect and also my technical analysis. The second plan is to do nothing and see if Google falls below 105 come 21st April. Let's say if the contract gets exercised before 21st April, I will be forced to sell away 100 Google shares at $105. This is okay to me because in one of my previous videos, I shared that my cost price for this 100 shares is $100. Therefore, when the contract gets exercised, I will lock in $500 profit from the sale, and adding the initial $285 premium to this trade, I will gain a total of $785 from this trade. Thereafter, I will sell a cash secure put, perhaps at $100 strike price again, something that I did last year. Basically, rinse and repeat, and this is known as the option wheel strategy. Lastly, of course, if the contract did not get exercised and Google falls below $105 on 21st April, I do not have to do anything at all. The profit from this trade will then be the premium of $285 that was collected right from the start. From here, I will sell another covered call. So yep, hope you get it. Always have a plan in mind. But again, I would like to caution, remind and emphasize that one should not follow my trades blindly, because I may close the contract anytime during the week and you wouldn't know until my next video. And sometimes I may not even update a particular trade. Therefore, please note that I am sharing them here for reference and learning purpose only. You have to do your own research. Alright, here are some of my thoughts on the current market. Personally, I think the market is a little confused right now. Why so? Well, investors are pricing in a possible pause in rate hike by the Fed, given the recent weak economic data, and they are also anticipating rate cuts before the year end. However, the Federal Reserve has previously mentioned that they will keep the rates at a high level for as long as it takes. That being said, we all know that the Fed tends to flip-flop their words and change their mind every now and then. To add on to that, previously, investors had cheered on the signs of a cooling economy and labour market, because it could force the central bank to change course on its interest rate hiking campaign. But then, some are now wondering if the Fed has gone too far and too aggressive in its bid to cool inflation and tightening the economy to the point of a recession. So basically, it's good news with a softening economy and labour market as it gets the Fed to pause or cut the interest rates, versus bad news because it means recession could really be coming. Therefore, this is the reason why I think the market sentiment is a little mixed right now, which somehow explains why the stock market has been trading at range bound recently. Whenever the bears want to push the market down, the bulls stayed resilient and held the market up. And when the market tried to rally big time, somehow sellers and bears will step in to push it down a little. On this type of trend, I have previously shared that a market that moves sideways are good for option traders if you know what strategy to use. It can be as simple as selling puts and calls. If you have time, watch my previous videos on some of the option trades that I have made over the last few months and try to understand how I have profited from this sideways market. Anyway, personally, I think it's a 50-50 call whether there will be another rate hike in May's FOMC meeting. As to whether will there be a rate cut by the end of the year, honestly, I don't have any sight or prediction of it, because a lot of things can happen in the next 6 to 8 months. For instance, many of us have not foreseen the recent banking crisis. As for the topic of recession, I am just adopting a wait-and-see approach and observe how the economy plays out. With all said, I still remain cautious despite the resilient stock market. I mean, to me, the Federal Reserve has built a wall of high interest rates, and now the economy, the job market, and businesses are running into it. This tall wall of interest rates is beginning to take a toll on the economy, and I believe there are enough issues out there for me to remain relatively cautious. I wouldn't want to fight the Fed, so overall I would say I am bearishly bullish, if you know what that means. Okay, so are you on the bulls or the bears camp? Comment bullish or bearish below. Wanted to have a sensing of the viewers' sentiment. Alright, that's all for this video. Don't forget to tap the like and subscribe buttons if you haven't done so. Thank you.